Let's say you have invested in units of a mutual fund. We know that trading of the units of mutual fund happens at its NAV, right? The net asset value. The NAV is increasing, and as a unit holder, as an investor, you have decided to sell the units. The moment you will sell the units, the mutual fund will have a contractual obligation of delivering cash, right? The mutual fund has promised to its investor that, see, whenever you will redeem your units, it will be liable to pay cash. So you sell the units, the mutual fund is under an obligation to deliver cash. We know a contractual obligation of delivering cash is nothing but a financial liability. So, are the units issued by a mutual fund a financial liability? Is it so? Think for a moment. Don't you feel that the units issued by a mutual fund or equity shares issued by a company, both are similar in nature? When equity shares are issued by a company, we are saying it's an equity instrument. So, are the units issued by a mutual fund an equity instrument for the mutual fund, or is it a financial liability? Okay, think in this way. The company is going into liquidation. As the company is going into liquidation, it will keep on disposing of its assets, isn't it? It will keep on repaying its liabilities. We know that the equity instrument holder shall be paid last. Ultimately, there are some residuary net assets. These residuary net assets will be disposed of and converted into cash. This cash is payable to the equity instrument holder. Wait for a minute. Is cash payable to the equity instrument holder? If cash is payable, then we know it's a financial liability. So don't you feel that equity instrument ultimately, which is getting repaid at the time of liquidation, is a financial liability? I hope you are getting my point, isn't it? Financial liability is understood as a contractual obligation of delivering cash. Whenever we are supposed to pay cash, we say it's a financial liability. When a unit holder is selling his or her units, we are supposed to pay cash as a mutual fund. When a company is going into liquidation, ultimately cash is payable even to the holders of equity instrument. Does this make these instruments financial liability, or should I consider them as equity instrument? This is the background that we really require to understand this new concept. Ind AS 109 is considering them as puttable instruments, right? This is the term that we are using, puttable instruments. Puttable instruments are considered to be an exception to the definition of financial liability. We understand financial liability as any contractual obligation of delivering cash or a financial asset other than cash. However, puttable instruments can become an exception to the definition of financial liability. It is possible that puttable instrument is classified in the books as an equity instrument. When is that possible? We will see that in a while. Before everything else, it is necessary for us to understand what do we mean by a puttable instrument, right? The word used is puttable. By puttable, they are referring to put option, right? In derivatives, you are having call option and put option. Call option is giving you a right to buy. Put option gives you a right to sell. So by put option, we mean right to sell. Okay, right to sell. Of course, you do not have any obligation to sell. Right to sell without any obligation. So if we examine now the definition of puttable instrument, here it is. They are saying puttable instrument is a financial instrument that gives the holder, right? The holder has the put option. That means the holder has right to sell. Remember, without any obligation to do so. Think about that earlier case. You are holding units of a mutual fund. So you are a holder, right? You are a holder of units of mutual fund. You have a right to sell the units to the mutual fund. You are not under any obligation to do so. The NAV may keep on increasing, but if I am a long-term investor, I may keep on holding these units as far as I wish. However, if I come to a conclusion that no, I want to liquidate my investment, I can always sell those units. So as a holder, I have a right to sell the units back to the mutual fund, but I am under no obligation to do so. So that's what we say here. It is a financial instrument that gives the holder, okay, what is the holder getting? A right to put, understand right to put as sell. You can say a right to sell the instrument back to the issuer for cash or another financial asset. That's the classical definition that we understand for units of a mutual fund. I am holding the units of a mutual fund. I have a right to put the instrument back. In other words, I have a right to sell the units back to the issuer. Issuer is the mutual fund for cash or maybe a financial asset other than cash. Or they say is automatically. Understand the difference now. Earlier you had a right to sell without any obligation to sell. But now they are saying it will be automatically put back. In other words, it will be automatically sold back. So now you cannot say you have a right to sell without any obligation. No, it will compulsorily get sold. Okay. So is automatically put back to the issuer on the occurrence of an uncertain future event. Some uncertain future event occurs, but it was already pre-decided that if such an uncertain future event actually occurs, then the financial instrument will be sold back to the issuer. For example, let us say a company has made it very clear that in the event of any employee found guilty of defrauding the company, if there were any shares which were issued to the employee at a concessional rate, those equity shares will be forfeited. You may use the word forfeited, or in the context of this understanding, you may say it would be automatically sold back. For example, the company had introduced an employee stock option plan in the past. Based on the ESOP, equity instruments of the company were issued at a concessional rate to their employees. However, let us say 1 or 2 years down the line, those employees to whom shares were given at a concessional rate are found guilty of defrauding the company. There was a long-running fraud which has now been unearthed. In the past, you were giving, at a concessional rate, you were giving shares of your own company to these employees. Now, these employees are found guilty of a fraud. If they are found guilty of a fraud, we cannot keep on giving them the advantage of the equity shares that were issued to them at a concessional rate. The terms of the agreement were very clear that if an employee is ever found guilty of a fraud, whatever equity instruments that were issued to them at a concessional rate will be forfeited. We have an uncertain future event over here. The future event is that a fraud has been detected and it was already made it very clear that it will be automatically sold back to the issuer. So these equity shares will be sold back. It will be bought back, or you may say forfeited, whatever you say. It will definitely make this a puttable instrument. Or this can even happen in the event of death or retirement of the instrument holder. This is what we understand as a puttable instrument. Either the holder is getting a right to sell it back to the issuer, or it will be automatically sold back to the issuer provided some future uncertain event occurs, or whoever is holding that particular instrument is dying or retiring. Okay, what further? They are saying that a puttable instrument can be classified as an equity instrument. Okay, puttable instrument is giving a contractual obligation of delivering cash or another financial asset, but still it can be classified as equity instrument. I can classify it as an equity instrument provided it fulfills all of the following conditions. And let me tell you, there are 6 conditions. If all 6 conditions are fulfilled, then this contractual obligation of delivering cash or this contractual obligation of delivering a financial asset other than cash can be considered to be an equity instrument. Although On the face of it, it looks like a financial liability, but I will classify that as an equity instrument. When? If 6 conditions are getting fulfilled. Okay. What are these 6 conditions? Condition number 1. Let's go one after the other. It entitles the holder to a pro rata share of the entity's net assets in the event of the entity's liquidation. You will get a pro rata share. Okay. For example, there is some person, let us say Mr. ABC. Mr. ABC has 10% shares. Okay, it has 10% shares of entity. When the company goes into liquidation, you will get 10% share in the residuary net assets. If this is so, then this will make it an equity instrument. That's the first condition is getting fulfilled. For example, you are having 10% shares, but you have another contract. That contract says that although you have 10% shares, but when the company goes into liquidation, you will get 15% share in the residuary net assets. Or you have 10% shares, but the contract says that no, although you have 10% shares, but at the time of liquidation, you will get only 5% share in the net assets. That means you are not eligible for your share in the net assets on a pro rata basis. If it is not on a pro rata basis, it will not become an equity instrument. Rather, it will become a financial liability. So whatever is your holding on pro rata basis, the same should be the share that you are getting in the residuary net assets of the entity. Okay. And of course, this is in the event of liquidation. One has to presume liquidation over here. See, a company is not going to go into liquidation. It's a very rare event. It's an infrequently occurring event. A company simply has to presume that by chance, if it goes into liquidation, will this person holding this instrument get share in the net assets on a pro rata basis, or more than that or less than that? If you say on pro rata basis, then the first condition is getting fulfilled. If you say it will be more or less than the pro rata basis, then it fails the very first condition. No need to see the other conditions. The moment the first condition is not fulfilled, it shall become a financial liability. An explanation, of course, has been provided. They are saying, in other words, the instrument should not entitle its holder to a higher or lower share of the entity's net assets upon the liquidation. Right? You have to just assume a liquidation and consider the same. Second condition, they are saying it is the class of instrument that is subordinate to all other classes of instrument. Subordinate means you are going to be paid last. Okay, your claims are the last claims on the net assets of the entity, again in the event of liquidation. So if a company is going into liquidation and you will be paid before anyone else, then you cannot say you are holding an equity instrument. We will consider that it is a financial liability. Okay, that's the reason we have a concept of preference shares, isn't it? Preference shares many a times are working very similar to equity shares only, but in the event of the liquidation, preference shareholders will be paid first and equity shareholders will be paid last. So are your claims subordinate? Subordinate means you should be getting the last priority. So second condition, if I go through it again, we are saying it belongs to a class of instrument that is subordinate to all other classes of instrument. That is, it has no priority over the other claims to the entity's assets on liquidation. Again, you have to assume liquidation, that by chance if the company goes into liquidation, will the holders of these financial instruments be paid last? Yes or no? If you say no, it becomes a financial liability. If you say yes, then it may become equity instrument provided remaining conditions are getting fulfilled. Condition number 3. Okay, what is condition number 3? They say, in case of puttable instruments, all financial instruments in the most subordinate class have identical features. Let us say a company has issued equity shares. One is of face value rupees 10 another is of face value rupees 100. Now you are saying they are equity shares, but there are two classes now. One has a face value of 10 rupees, another has a face value of 100 rupees. At the end of the day, we are considering both of them as equity shares. But what if I say that this, at the time of liquidation, this will be paid first and this will be paid last? Okay. When you say equity shares, we normally understand equity shares as an equity instrument. Why equity instrument? Because we are of the view that when the company goes into liquidation, holders of equity shares will be paid last. But then I make a distinction between the two. Are you holding equity shares of face value 100 or are you holding an equity share of face value rupees 10? Okay, you have 100 rupees equity shares. Okay, I will pay you first. Okay, and those who are having 10 rupees, I'll pay them last. How is this possible? Isn't it? This just means that although they are equity shares, they do not have identical features. If you say they are equity shares, both of them will have identical features. You get my point? So this is the case that we are suggesting over here. If you are saying it is an equity instrument, then all the equity instruments will have identical features. Otherwise, it will not become an equity instrument. It shall become a financial liability. So they say, in case of puttable instruments, all financial instruments in the most subordinate class have identical features, right? For example, they must all be puttable. Agreed. Puttable means they will be sold back to the company. And the formula or other method used to calculate the repurchase or redemption price is the same for all instruments in that class. So whether you are holding equity shares of face value rupees 10 or face value rupees 100 or for that matter any other face value, you should be ultimately paid last. Your claim should be subordinate to claims of all other holders of financial instruments. Only then it can become an equity instrument. Condition number 4, it says, in case of puttable instruments, apart from the contractual obligation for the issuer to repurchase or redeem the instruments for cash or another financial asset, there are no other contractual obligations to deliver cash or another financial asset or to settle in variable number of entities own equity instruments. Having a contractual obligation of delivering cash or another financial asset or settling it by issuing variable number of equity instruments, that is your own equity shares, these are features of a financial liability. You should not have any such contractual obligation. For example, a company has issued preference shares. Think in this way, a company has issued preference shares. Now, when it comes to the dividend will be paid at the discretion of the management. That means the preference dividend is becoming as good as equity dividend. Okay, not only that, the redemption of the preference shares will happen again at the discretion of the management. Whenever the management feels like, at that point of time, it will redeem those preference shares. So the redemption of this preference shares at the discretion of the management is again making it very similar to an equity instrument. So what has happened is, I will like to classify these preference shares as an equity instrument. However, when we do proper analysis of this preference shares, we realize that these preference shares are convertible into equity shares. The formula of conversion is that after 5 years, whatever is the MPS, at that MPS of the equity share, at the MPS of the equity share, the preference share will get converted into equity shares. Now, because the conversion will happen at then existing MPS, if the MPS is on a higher side, fewer number of shares will be issued. If the MPS is on the lower side, more number of shares will be issued at the time of conversion. In other words, the preference shares will pay dividend at discretion of the management, very much like equity share. The conversion will happen also on some future uncertain date, very much like an equity instrument, but ultimately it will be converted into either higher number of shares or lower number of shares. That is, it will get converted into a variable number of equity shares. Variable number of equity shares, that is nothing but a feature of financial liability. These kinds of puttable preference shares cannot be classified as equity instrument. So you are fulfilling condition number 1, condition number 2, condition number 3, but you have issued the puttable instrument in such a way that ultimately it will get settled in variable number of equity instrument of the issuer. It will not become an equity instrument. Yes, if this was convertible into a fixed number of equity shares, then it will fulfill condition number 4. But because variable number of equity instruments are required to be issued, it has a feature of a financial liability. Condition number 5, a very regular condition. If it is really an equity instrument, they say, in case of puttable instruments, the total expected cash flow attributable to the instrument over the life of the instrument are based substantially on profit or loss, or change in the recognized net assets, or change in the fair value of the recognized and unrecognized net assets of the entity over the life of the instrument. Think about investment in equity shares. They are saying that the expected cash flow attributable to the instrument, I am investing, think in this way, you are investing in equity shares of the company. We want to know what shall be the cash flow. Now, one of the important cash flow that we will get from an equity share will be dividend. Can we say dividend will depend upon the profit or loss that the company will earn or incur? By chance, if the company is incurring a loss, perhaps there will not be any dividend. If the company is earning profits, it will pay dividend. Dividend is nothing but the cash flow that will be generated from this puttable instrument. But this cash flow is dependent upon the profit or the loss. Or it may be dependent upon the change in the recognized net assets. The net assets value is increasing, decreasing. That will also affect how much of the cash flows that will be generated. Because another cash flow that will be generated will be from the sell, right? If you sell the equity instrument on the stock market, then also cash flow will be generated. This cash flow will be generated by selling the equity instrument. Now that is nothing but the market price per share. How will the MPS on the stock exchange increase or decrease? One of the parameter, of course, will be profit or loss. Another parameter can be the net assets. You are acquiring some another company, your net assets will increase. Similarly, you might be demerging or you are selling a unit, your net assets will decrease. So change in the net assets is also that is going to affect the cash flow that will be generated. Okay. And of course, the change in the fair value of the recognized and the unrecognized net assets of the entity over the life of the instrument. So net assets will change. As the net assets changes, their fair values will change, and accordingly the cash flow will be generated. So if you have really invested in a puttable instrument, this will be the source of the cash flow. It will be dependent upon the profit or loss that a company is earning. It shall be dependent upon the changes in the net assets. It shall be dependent upon the change in the fair value of those net assets. So accordingly, the cash flow will be generated. If the cash flow is going to be generated on the basis of any other parameter, then it is not fulfilling this condition. For example, you have invested in an equity instrument and the company says that, see, whatever is the change of the MPS on the stock market, on the basis of that, we will pay you dividend. So dividend is not dependent upon the profit or loss of the company. The dividend is dependent upon the performance of the share on the stock exchange. So the company is building an index. The day when it is issuing the equity instrument, it is considered the index value to be 100. And from that day, it is tracking the performance of the share price on the stock exchange. It is creating an index. And on the basis of that index, it will decide what is the amount of dividend to be paid. This time, the cash flow is not dependent upon profit or loss. The cash flow is not dependent upon the net assets. The cash flow is not dependent upon the changes in the fair value of those net assets. It is dependent upon an index. It is dependent upon some another parameter. It is no longer fulfilling this condition. it is no longer an equity instrument. It shall be classified as a financial liability. Explanation is there. They say, I'm reading this portion. In other words, if the cash flows are attributable to any factor other than the three listed above, for example, an index, the puttable instrument will fail equity classification. If it fails equity classification, it shall become a financial liability. And finally, the last condition. Finally, a last condition. It's quite possible that you may fulfill all the first 5 conditions, but if you fail to fulfill the 6th condition, in other words, there is some another contract, then it shall again become a financial liability. For example, think in this way. For example, you are having 10% shares. Okay, you are having 10% shares. Now, when I am analyzing this financial instrument, you will get a pro rata share in the net assets. Okay, when it's time for liquidation, you are going to be paid last. There is no obligation of delivering cash or any other financial asset, nor it is convertible into any variable number of equity shares. Whatever are your cash flows will depend upon profit or loss. But apart from this equity shares that you have in this entity, you have another contract. Okay, there is another contract. This contract is to provide, let's say, asset management services. Asset management services. And as consideration, okay, as consideration for these services, you will get 30% share in net profits. 30% share in the net profits. Now, normally industry standard or the industry practice, okay, industry practice is 3% share, or let us put a range, 3 to 5% share in net assets. So if you are entering into any contract with a party which will provide you with asset management services, the normal industry practice is that we can share 3 to 5% of the net profits with them. But your contract is to share 30% of the net profits. This means all the first 5 conditions are getting fulfilled, but the 6th condition will not be fulfilled, and this will again become a financial liability. You know, it is something like this. Something like this. I am issuing 10% equity shares of my company to you. I am making it very clear to you that, see, in the event of liquidation, you will get only 10% of the net assets. You say, fine. Obviously, this is how it will be. I make it very clear to you that, see, in the time of liquidation, your claims are subordinate. You are going to be paid last. I also make it very clear to you that no variable number of additional equity instruments will be issued to you. I also make it very clear to you that, see, for these 10% shares that you have, your cash flows will be decided by either the profit or the loss, or the change in the net assets, or the change in the fair value of the net assets. Everything is fine. Till here, everything is fine. But then I tell you to make this investment attractive. You are like that, okay, all these things are fine, but why should I invest in your company's share? Think in this way, I'm in need of money and I'm ready to issue 10% equity shares of my company to you. I say that these are the features of these equity shares. You will get only 10% share in the net assets in the event of liquidation, but you are not thinking of liquidation at all. If you are investing in my company, please understand, if you are investing in my company, you are thinking about a bright future prospect of my company. No one is going to invest in my company thinking about liquidation. You get my point. If you are buying shares of Reliance Industries, for example, you are not thinking about that what will happen at the time of liquidation of Reliance. Come on. If I come to the conclusion that this company will very soon get liquidated, I will never buy shares of that company. So when I tell you that at the time of liquidation, you will get 10%, you are like, who is thinking about liquidation? When I tell you in the event of liquidation, I'll pay you last, you are like, okay, fine. I'm not thinking about liquidation at all. When I say you will not get any additional equity instruments, you are okay with that. When I tell you that the cash flow will be decided, I mean the dividend will be decided by profit, loss, net assets, everything is okay. I am in need of money, and that's the reason I'm issuing 10% shares of your company's share. You are like, I will give you money by subscribing 10% shares of your company, but what do I get in return? What am I getting in return? I'm not investing in your company because I want dividend. Whenever you will declare dividend, if I have 10% shares in your company, I will get 10% dividend. I am not investing in your company because of that. I am investing in your company because I want a good, decent return. So what I do is I issue 10% equity shares of my company to you, and at the same time, I and you very quietly enter into another contract. I suggest to you that as per this contract, you have to provide asset management services to me. And although the industry practice is to share 3 to 5% of the net profits, I will share with you 30% of my net profits. So this will adjust the return that is available to you. I am making the deals a very sweet deal for you. I am in need of money. I will issue 10% shares of your 10% shares of my company to you. Of course, for 10% shares, I will receive the consideration. But in order to make this an attractive investment, I will now, through another contract, give you 30% share in the net profits. And this is what will make it an attractive deal for you. However, these 10% shares which I have issued, I will have to now classify this in my books as a financial liability. I will not be able to classify this as an equity instrument because it will fail to fulfill the final sixth condition. What is the final sixth condition? It says the issuer must have no other financial instrument or no other contract that has total cash flow on the same terms as phi above, with the effect of substantially restricting or fixing the residual return to the puttable instrument holders. The moment I suggest to you that I will share 30% of the net profits to you, as far as other equity shareholders are considered, as far as other puttable instrument holders are considered, I have restricted their return. Don't you feel so? If 30% of the profit is paid to you for asset management services, that means only 70% of the net profit is now available to the other puttable instrument holders. I have restricted their return thanks to this contract that I have entered with you. And that's the reason the sixth condition will be not satisfied. The moment the sixth condition is not satisfied, this is no longer an equity instrument. I'll have to classify this as as a financial liability.
Press the bell icon on the YouTube app and never miss another update.